What's up, guys? Dwight with Defying Finance. I want to go over a couple things right now. If you didn't hear yesterday, the report had come out that GDP so far this year is estimated to be negative 1.4%. And of course, this is annualized. So over the year, we'll have to see how it changes. But this goes along with exactly what I've been saying. We're going into a recession. Now, the government would call this a recession once they get 2 consecutive quarters of negative GDP. So if next quarter it wasn't negative, and then the quarter after that, so Q3 it was negative, they wouldn't call that a recession, right? But remember, those are also lagging indicators. So if we get a negative report next quarter, so by the end of the second quarter, then it just means we've been in a recession for 6 months, right? These are lagging indicators. I think most of us could probably look around and realize that there's a problem in the economy, right? This is a lot of the same type of stuff we were seeing back in 2000, 5, 6, and 7. As the housing market was imploding, you have the media out there saying, well, this is fine. There's nothing's going to happen with this. It's, subprime's a small thing, and it wasn't, right? I remember Art Laffer. I remember seeing this, watching Peter Schiff and Art Laffer live, right? And Art Laffer making that bet with him. I remember just, back in 2006, watching Robert Kiyosaki talk about these things. Nobody listened. All right. And unfortunately, we're there again. So I want to pull this up on my screen here. Let me switch it over. So this is from Yahoo Finance. Now, this article is kind of funny. It says U.S. GDP falls in first quarter as surging imports knock down growth. Right. I highlighted a couple things here. So I think it's sort of ridiculous. The first GDP contraction since the recession ended is sure to ignite fears that the economy is stalling out, but on closer inspection, the report isn't as worrisome as it looks. Come on, right? This is spin. That's what happens. This is spin. It's kind of like in politics, people running from office. This is spin right here. And down here, beneath the weak headline print, the details of the report point to an economy with solid underlying strength. And read down here, the economy is expanding at such a brisk pace that Americans turn to external sources to meet demand. This is crazy talk, right? Consumer spending is up because of debt. And I'll show you some of these charts. But what you are about to see is the economy roll into an official recession. Now, this is sooner than I expected, for sure. I know the Fed, was jawboning a lot about raising rates. They're not really raising rates that much yet. You're talking about 1/4%, 0.5%. Like, that's a joke. Paul Volcker brought this up to like 20%, right? Back in the day, to really kill inflation. So it's a little different this time in the sense that we actually have price inflation, and I'm making that specific because inflation is actually the expansion of the currency supply. It's been that way forever, right? Till around, I think it was somewhere around 1990, 1991. You could go look at dictionaries prior to that, and you'd see that inflation was the expansion of the currency supply. Eventually, they changed that to the rising of prices. So what you end up doing is treating a symptom, not the problem. So let's take a look at a couple of these things. So I want to point this out. This is important. So this is the annualized data. Okay, in 2020, right? We had a pretty crazy year in 2020, right? It annualized out at negative 3.49%. Now, mind you, right now, it's coming out at negative 1.4. We just started the year. Okay. So considering we shut down an entire world economy, and it ended up negative 3.49 for us, being at negative 1.4 is sort of a big deal. For the year, we'll see where this ends up coming in at. But if we scroll down here, the last time we had larger numbers like these was 2009. What happened before 2009? 2008, right? So negative 2.54 here in 2009. Let's scroll down more. When's our next major negative. So the closest one would be in 1982. Okay. Now, this was at the end of when we had inflation through the 70s. We had stagflation, right? I think Paul Volcker, didn't he do all this in 1980, rolling into 81, I believe? He jacked interest rates up to just, smack inflation to the ground. Well, I don't think they can do that again this time. We have way, way too much debt. Matter of fact, let me pull up this chart. This is the United States debt to GDP, right? I mean, this goes way, way, way back. But looking at it here, I mean, we're at a place right now where our debt to GDP is higher than in World War II. This is like, that's nuts, right? At some point, you can't return to normal without an incredible collapse. The timing of that is the hardest part. Let's look at some more of this because this is very close, right? We have this contraction here. Paul Volcker raises rates to the moon. I think it's up to like 20%. That's the Fed's funds rate, right? That's really, really high. But of course, we didn't have as much debt back then, so it didn't hurt us as much. If they tried to raise rates up today, you just say 10%, we couldn't pay the interest on the national debt. It's too short term. We don't have as much long term debt, right? We've been rolling it over in shorter and shorter terms. It's like an adjustable rate mortgage, which, by the way, I should do a video on the housing market. All these realtors talking about the housing market's going to keep going. It looks like it's over unless the government, pivots on something. I'll go over that in another video. But anyway, just taking a look at some of this, I pulled up an article back in, what would this be? Consumer debt rose 15.6 trillion in 2021. So this is coming up towards the end of 2021, so we could get an idea. So consumer debt, so the reports you're hearing now about this quarter, a lot of that stuff continued into this quarter of this year because of consumer debt. So when you hear them talking about, that spending is great, right? If the spending is due to just credit card debt or just car loans, stuff like that, right? Is that a good thing? Right? If you have to use that, that's the difference. If you chose to use it, that's one thing. If you're paying it off every month, that's fine. But we're talking about the debt that sits around on that. That's not a good thing in your personal finances. That tells you people are really feeling the effects of inflation, and what they're doing is they're adjusting their wages with a credit card, right? So let's say someone was making $20 an hour, but their daily living expenses rose 10% across the board, right? Now it's probably higher than that. Rent's gone up a lot. Food prices have gone up a lot more too. But let's just say it's 10%. They're making up the difference of their loss from their work, right? Where now they might need $21 an hour to survive the same lifestyle that they had. Well, that extra dollar an hour, they're making up for it by using a credit card. That's what you're seeing right now. So let's continue. Let me bring this back up for you. So that's at the end of 2021. Consumer debt in U.S. surges by a record $40 billion. Figure was nearly double that of the median estimate in the survey. Jump shows rise in credit card balances, non-revolving loans. This was January 2022. So you can see where some of this is coming from when they talk about in this article that, oh, well, spending is great though. So the underlying economy seems to be in really good shape. It's bogus. This is all spin. That's all this is. It's not good. Like in your personal situation, if you had to do the same type of thing, like just keep borrowing money to live, does that sound like a good personal economy? No, it doesn't, right? So the government has been doing this. I mean, go back to that US debt to GDP. The government is borrowing more and more and more, right? Same thing right here. They're borrowing more and more and more compared to their income, or the that's not necessarily what this is showing, but against what the economy is creating in value, right? And even this GDP, it's still really hard to go by. Here's an example. I heard a great breakdown by Peter Schiff a long time ago. He has this analogy where he talks about a Callaway golf club, and basically, let's say the handle to this golf club is made in this country. The head of the golf club is made in this country. Maybe the grip is made in this country. It's all shipped to the United States, and then they put it together and say, "Oh, look, we created a golf club." But really, we didn't manufacture all that. Like, we didn't create everything. We really just stuck a few things together. Oh, there we go, right? We count that in our GDP. We didn't really manufacture anything. It's really manufactured somewhere else. But let's keep going on this. So this is household debt over the long term. All right, this goes back into what, 1946? You can see why everything has gone up in price. So this is part of inflation right here. When you look at this chart, this is part of inflation. When you slide your credit card, you're creating money out of thin air. That currency didn't exist prior to this, right? If the Federal Reserve gives a bank credit, and then you go spend on your credit card, right? And you say you spend $100, that is created. And then when you pay it off, it's destroyed. So recessions, in a way, you can see on these gray lines here, let me switch back to this chart. Recessions also destroy some of that debt. So that's where you end up getting these depressions, right? But if the government ends up printing a ton of money during that time, if they're just doing it enough to offset the debt destruction, that's one thing, but that's never what they end up doing, right? They're not raising your taxes. They're just printing money. That's what they're doing. It's really currency, not money. But one other thing I want to keep going here. This is a different type of chart. This is just U.S. credit card debt. You can see the trajectory here when they're talking about, oh, but consumer spending is great. It's from credit. It's not like it was consumer spending was increasing due to the value you're getting from your workplace and you're spending your cash, right? You're going into debt, and someday that reverses. So I went and created this chart on the Federal Reserve's website here. So I wanted to show this. It has to do with consumer loans. Now, this is credit cards and other revolving plans, all commercial banks, compared to gross domestic product. But what I did is I did the year-over-year percentage change. So you can see GDP starts to climb as the year-over-year change in debt was falling due to this 2020 crisis, right? But then you see it start to just explode up, right? This consumer credit card debt just is ripping. But look, you're starting to have GDP slow. The year-over-year change in GDP is falling as consumer debt is rising through the roof. This isn't even helping GDP grow anymore, right? We are heading into a recession. I don't care what anybody tells you. We're heading into a recession. You might see different headlines in the future talking about how we'll get out of it, or maybe the government, or not the government, the Federal Reserve, maybe they pivot, right? Maybe they stop raising rates. But I think what they're trying to do right now is to use one of these gray areas for a recession to destroy some of that debt. They're trying to push their interest rates up because other countries, like you look at Japan right now, Japan's currency is just crashing, right? I think they're down 20, 21, 22%. Maybe you guys can correct me in the comments. I think today is what, April 29th or 30th? I don't have it in front of me right now. But anyway, at the time of this recording, maybe you can correct me down there in the comment section. But all these other countries, their interest rates on their debt is very, very low. So the United States sort of has a benefit as they continue to raise these rates and try to jawbone the market into raising these rates for them so they don't have to do it, really, is what's happening. other countries start to buy United States debt and sort of push that down at the same time. But what happens with that is the Federal Reserve Bank could also sell those treasuries into the market and let the market sort of absorb that, put it back on the people. So this is going to be really, really interesting. But I don't think this is going to play out well. I don't think they let us totally go into some sort of depression. I think they're going to print money. That's what they're going to do. But first, they want to get to this point where they can raise rates enough that they have a little bit of room to drop them. But I don't know if they're going to make it as far as they think they're going to go. But I'd be watching for another type of crisis, for them to pounce on something with Russia, to blame Russia for something. Maybe there's maybe a bank collapses in Japan, or maybe in Germany. Maybe a bank collapses there. Maybe even Deutsche Bank goes down, and it turns into this financial crisis, or maybe an Asian financial crisis that happened to affect us. We were on our way to a recovery. That's too bad. And if only that didn't happen, we would have been okay. It's not true. They're just going to take every opportunity. So the things that I continue to look at is gold and oil. Of course, I've been in gold for a long time. That's just something, I've always had a little bit. Mining stocks, I've always I've had a little bit of those. But crypto, I'm still very, very heavy into crypto, and I just keep buying as I see these things go down. I continue to buy them, but quality projects that are actually solving a real problem is usually what I'm going after. But I'll roll my money into US dollar coin, and I'll sit there and watch these. And as they just get beat up, I come in and start buying these huge, huge dips. I did a video on the S&P 500 recently. You can go watch that. I think it was the last video I did, actually. Some of these are starting to look like better and better deals. I think there's a little maybe market psychology you could still play, but some of these are starting to turn into fair deals. I'm watching the PE ratios on specific stocks and just seeing where these end up, right? I guess the scary part would be, let's say we go into a really, really heavy recession. Some businesses could go out of business. So you don't want to end up owning those stocks and just think, oh yeah, I'm gonna buy the dip on this one. It fell down to $1. And then, they file bankruptcy, your stock's wiped out. As a common stock shareholder, you're not going to get anything for that. So yeah, you got to keep some of that in mind. But I really think it's going to be a tough next 3, 4, 5 years. I'd be watching the housing market. I think overall, the U.S. housing market is going to go down, but there are going to be pockets that are still great areas to buy. And I'm thinking one of those areas are going to be parts of Florida. We're still looking at that area for investment properties right now, even though rates are climbing. I don't care. I'll just refinance it in the future, right? And even if prices fell 20%, I don't care. It's a cash flow property. So buying, making sure it cash flows, of course, that would be important. But anyway, if you found this helpful, make sure you like and subscribe, share it with somebody. And if an ad pops up, watch an ad. I don't get anything from this right now, but it is free content. But anyway, I will head out of here. I'm going to continue making a couple other videos. I think they might not come out. I'll schedule them maybe throughout the weekend. They'll just pop up. But I've been really busy lately, so I haven't had a ton of time to make videos. But anyway, thanks for watching, and I'll see you on the next video. Have a good one.